Breaking news that should alarm every American watching right now. In what analysts are calling the most dramatic escalation of the US-China trade war in modern history, American markets just hemorrhaged over $50 billion in a single week as Beijing unleashed a retaliation strategy that caught Washington completely off guard. We're not talking about theoretical economic models here. We're talking about real money vanishing from retirement accounts, real jobs disappearing from manufacturing towns, and real price increases hitting families from Michigan to California. In the next 13 minutes, I'm going to break down exactly how we got here, who's paying the price, and why experts warn this could be just the beginning of a much deeper economic crisis. The question everyone's asking, how did we let it get this bad? Let me paint you the picture of what just happened. Throughout 2025, the Trump administration has been engaged in what can only be described as the most aggressive tariff campaign in over a century. By October, the average U.S. tariff rate on Chinese goods had skyrocketed to 47.5%, covering 100% of all imports from China. That's not a typo. Every single product coming from our largest trading partner now faces tariffs averaging nearly 50%, and it gets worse. When President Trump imposed an additional 50% tariff increase on April 9th, bringing baseline tariffs on Chinese imports to a staggering 104%. Beijing didn't hesitate. China responded with matching tariffs of 84% on American goods. The market reaction was immediate and brutal. On October 10th alone, the S&P 500 plunged 2.71%. The Nasdaq crashed 3.56% and the Dow dropped 1.9%. Wiping out billions in shareholder value in a single trading session. But here's what makes this different from previous trade disputes. This isn't just about soybeans and steel anymore. China's retaliation strategy has been surgical and devastating. On March 4th, Beijing slapped 10 to 15% retaliatory levies on approximately $21 billion worth of U.S. agricultural exports. American farmers, already struggling with tight margins, suddenly found themselves priced out of one of their largest export markets. Take the Johnson family in Iowa. For 3 generations, they've grown soybeans destined for Chinese markets. Last year, those exports represented 40% of their revenue. This year, Chinese buyers have vanished. We're sitting on grain we can't sell, Mark Johnson told reporters. The tariffs made us uncompetitive overnight, and it's not just agriculture. Technology companies with Chinese supply chains saw stock prices tumble. Gap saw its share price crater during the April tariff escalation. Target, Western Digital, Wayfair, Fortune 500 companies that rely on Chinese manufacturing or Chinese consumers all took massive hits. According to the Tax Foundation, these tariffs now amount to an average tax increase of $100 per U.S. household in 2025, rising to $1,400 in 2026. That's money coming directly out of American wallets. So, how exactly do tariffs work? And why are they backfiring so spectacularly? Let me break this down in simple terms. When the United States imposes a 25% tariff on Chinese goods, that's not a tax paid by China. It's paid by American importers. Think of it like this. Like, when a U.S. company orders $100 worth of products from China, they now have to pay $125 because of the tariff. That extra $25 goes to the U.S. Treasury, but the company has 3 choices. Absorb the cost and take lower profits, pass it on to consumers through higher prices, or find a different supplier. In reality, what we're seeing is a combination of all 3, and none of them are good for the American economy. The Yale Budget Lab conducted extensive research and found that the 2025 tariffs are slowing U.S. real GDP growth by 0.5 percentage points in both 2025 and 2026. In the long run, they project the U.S. economy will be persistently 0.35% smaller than it would have been without these tariffs. That might sound small, but we're talking about hundreds of billions of dollars in lost economic output. Here's the critical data. From January to April 2025, the average applied U.S. tariff rate exploded from 2.5% to an estimated 27%, the highest level in over a century. To put that in historical perspective, we haven't seen tariff rates this high since before the Great Depression, and we all know how that story ended. The mechanism creating this crisis is what economists call supply chain disruption combined with retaliatory market loss. American businesses that spent decades building efficient supply chains through China suddenly face crippling cost increases. They can't simply move production overnight. That takes years and billions in capital investment. Meanwhile, their products become more expensive for American consumers. On the flip side, U.S. exporters, particularly in agriculture, manufacturing, and technology, are getting absolutely crushed by Chinese retaliatory tariffs. China's response brought their tariffs on American goods to 31, 9% on average, effectively pricing U.S. products out of the world's second largest consumer market. Think of the trade war like two neighboring stores that decide to ban each other's customers. Both stores lose revenue, both stores' employees suffer, and the customers in the community pay higher prices because there's less competition. Nobody wins. Research from Harvard and Goldman Sachs found that U.S. consumers are bearing more than half the cost of these tariffs. The Consumer Price Index has increased by 0.7%, directly attributable to tariffs since March alone. When you impose tariffs on imports, roughly 14 to 20% of those costs show up in retail prices within 6 months, according to Econofact research. We've seen this pattern before. During the Smoot-Hawley Tariff Act of 1930, the United States raised tariffs on thousands of imported goods. Other countries retaliated. Global trade collapsed by 65%. And the policy is widely credited with deepening and prolonging the Great Depression. The Trump administration argues these tariffs will bring manufacturing jobs back to America and reduce our trade deficit. But 10 months into this strategy, the data tells a different story. U.S. manufacturing employment has been falling, consumer costs are rising, and the trade deficit with China, while slightly reduced, has simply shifted to other countries as supply chains reroute through Vietnam, Mexico, and other nations. Let's talk about who's really paying for this trade war, because it's not who you've been told. Remember that $100 average tax increase I mentioned? That's not theoretical. Families are seeing it in their grocery bills, their electronics purchases, their furniture costs. The Guardian spoke with dozens of American consumers who reported significant price increases across categories from clothing to home goods. Empty shelves and higher prices was the common refrain. A family in Michigan reported their monthly budget stretched by over $200 due to increased costs on everyday items, many of which have Chinese components, even if they're assembled elsewhere. The St. Louis Federal Reserve confirmed that tariffs raise the cost of imported inputs and imported final goods, and a substantial portion gets passed directly to consumers. When you walk into Target or Walmart, you're paying Trump's tariffs at the register. Here's a case that keeps me up at night. Sandra Martinez runs a small furniture business in North Carolina. She imports hardware components and fabrics from China because American suppliers either don't exist or charge 3 times as much. The tariffs increased her costs by 30% almost overnight. She had 2 choices: raise prices and lose customers, or maintain prices and operate at a loss. She tried splitting the difference, raising prices 15% and absorbing the rest. Within 3 months, her sales dropped 40%. She's now considering closing a business her father started 30 years ago. Multiply Sandra's story by tens of thousands of small businesses across America, and you start to understand the real human cost of this policy. The Fortune 500 hasn't been spared. An analysis by Fortune magazine identified the companies most exposed to tariff volatility. The consumer cyclical sector, retail, apparel, vehicles, has taken direct hits during the April escalation period. Gap's stock plummeted. Target saw significant losses, and Western Digital faced massive pressure due to its Chinese supply chain exposure. Tech companies have been particularly hard hit. Many rely on Chinese manufacturing for components or assembly. Apple, while not exclusively dependent on China, saw supply chain costs increase. Smaller tech companies without Apple's resources got devastated. And here's the geopolitical consequence nobody's talking about enough. While the US and China are locked in this tariff death spiral, China has been busy. Beijing recently announced zero tariff policies for 53 countries, pointedly excluding the United States. They're building alternative trade relationships, positioning themselves as the reasonable party in global commerce, while America looks increasingly protectionist and unreliable. American farmers who used to export to China are watching helplessly as Brazilian and Australian competitors fill the void. Those market relationships built over decades won't simply snap back even if tariffs eventually get reduced. The ripple effects extend into unexpected sectors. The housing market, already under pressure, faces additional strain. The American Action Forum estimates Trump administration tariffs could result in 450,000 fewer new homes through 2030 because tariffs on lumber, appliances, and construction materials increase building costs. Morgan Stanley analysts project that if tariffs remain at current levels, we could see consumer spending growth slow by 2 percentage points over the next year. That translates to retailers closing stores, restaurants shutting down, service jobs disappearing, all because consumers have less disposable income after paying higher prices for goods. The question isn't whether Americans are being hurt by this trade war. The question is how much worse it's going to get before somebody blinks. Legal and economic experts have been sounding alarm bells for months, and their warnings are proving devastatingly accurate. The Peterson Institute for International Economics called Trump's tariff strategy economically reckless, noting that tariffs on Canada, Mexico, and China alone would cost the typical U.S. household hundreds of dollars annually in increased expenses. Their research shows that future waves of U.S. tariffs and retaliation will multiply these costs alongside other economic harms, including reduced innovation, decreased competitiveness, and slower wage growth. As analysts have repeatedly pointed out, the core claim driving this policy that China pays for the tariffs is simply false. Politact and multiple economic research institutions have thoroughly debunked this. American importers pay the tariffs and American consumers bear the ultimate cost. It's Econ 101, and yet the policy continues. Here's what really concerns analysts looking at the medium-term consequences. The Federal Reserve is in an impossible position. Tariffs are inflationary. They drive up consumer prices. Normally, the Fed would raise interest rates to combat inflation, but tariffs also slow economic growth. Raising rates in a slowing economy risks triggering recession. It's the classic stagflation trap that destroyed the economy in the 1970s. Political reactions have been telling. The White House maintains that temporary pain will lead to long-term gains through reshort manufacturing and better trade deals. But congressional Republicans, many from agricultural districts, have quietly expressed deep concern. Some have called for tariff relief, though few want to publicly break with the administration. Democrats have attacked the policy as a massive tax on working families, though their messaging has been muddled by the fact that protectionist sentiment has bipartisan support in certain sectors. Public sentiment is shifting dramatically. Polling shows that while Americans initially supported getting tough on China, enthusiasm evaporates when they connect tariffs to higher prices and job losses in their own communities. Looking at the next 30 to 90 days, we're likely to see continued market volatility, more companies announcing supply chain adjustments, and potentially more aggressive retaliation from China. Beijing has shown remarkable patience and strategic thinking. They're playing the long game while American policy whipsaws between threats and temporary truces. The 6 to 12-month scenario, if tariffs remain at current levels, expect measurable impacts on GDP growth, continued inflation pressure, and potentially the recession that economists have been warning about. Corporate earnings reports will reflect the damage, and we'll see more stories like Sandra Martinez's furniture business. American dreams crushed by policy decisions made thousands of miles away. But here's what really concerns analysts. Once you destroy trade relationships and supply chains, rebuilding them takes years or even decades. The damage being done right now may be permanent. Let's recap the 3 critical points you need to understand. First, American consumers and businesses are paying for these tariffs through higher prices and lost market access, not China. Second, the economic damage is real, measurable, and accelerating, with $50 billion evaporating from markets in a single week and hundreds of thousands of jobs at risk. Third, China's strategic response is isolating America economically while building alternative trade partnerships that will last long after this trade war ends. If you want to stay informed on stories the mainstream media won't fully cover, make sure you're subscribed and hit the bell icon so you don't miss the next breakdown. Thanks for watching.